Hello, and thank you for joining me today. I'm Gary Massa with Pacific Sotheby's Realty, and I wanted to discuss a couple of the biggest trends that's going on in the real estate market today. And to do that, I've invited a couple of special guests in today to help me address and discuss some solutions for these challenges. Mortgage expert Andrew Paul from Benchmark Mortgage and 1031 exchange expert Tommy Hinson from Investors 1031 Exchange. Good morning, gentlemen.
Morning. Morning. Thanks for having us.
So as I mentioned, the biggest unspoken trend in real estate that I see today is the downsizing movement, okay? Whether it's people that are just now getting out from underneath the financial squeezes of 2008 to 2012 and can now, try to change that later or into the future, or there's the clients that I have that, have the big property, the acreage, the pools, the yard to maintain, and they just don't want to do it anymore.
Yeah, kids have all left the house and they need something smaller.
That's exactly right. And there are some challenges that surround that there are some creative solutions, which you guys have given me some great information that I want to share with everybody else. So I've brought a couple of questions that have come up recently with a few of my clients, and I wanted you guys to offer your expert advice or solutions on how to get through those. Okay. Sound good?
Fantastic.
Okay. The first question would be for you, Tommy. This particular client had owned their home for 15 years, and they were asking me, I've got an enormous gain on my property. Is there any way that I could avoid or just lessen the capital gains that I might get on this property?
Yes, it's a great question. Actually, a lot of people are aware that there's a 121 exclusion, which allows someone who owns a property and has lived in the property to not pay up to $250,000 of single or $500,000 if married in those gains. So if you have a client who's, has a gain of $500,000 or less, they'll be covered under the 121 exclusion.
So, Tommy, what if the gain exceeds $500,000? Like, let's say somebody has, an $800,000 gain on a property.
Mm-hmm. Yeah, and we actually see that a lot in San Diego. There's a strategy that was created through the American Jobs Creation Act in 2004 that allows you to take a 121 and combine it with what we call a 1031. And a 1031 is an IRS code that allows a seller of investment real estate to defer paying their capital gains taxes, including depreciation recapture, as long as they reinvest that into a new investment. So the 2004 Act actually allows you to use the 121, take your $500,000 in tax-free money. Any additional gain after that, you can combine that and roll it into a new investment through a 1031 exchange.
Okay. So what about, these clients really seem to be wanting to simplify their life. Is there any way to take that whole entire $800,000 gain and put it into something that they can retire into at some point?
There are some possible solutions to doing that. You really need an expert, someone like Investors 1031 Exchange or your CPA. But the strategy is there. It's just it's very complicated and it can be done then.
Okay, great. So Tommy, another question that comes up often is, a lot of my clients have multiple investment properties, but they're just done with managing tenants and everything else. Is there a way to consolidate or sell those investment properties and use those funds to buy a home that they might retire in later, or how could they simplify that?
Yeah, what we're seeing is a big trend, especially with the baby boomers that have acquired a lot of real estate. They're tired of dealing with the maintenance and the management of those properties, and so when you do a 1031 exchange or you combine a 1031 with a 121, there's multiple things you can invest that money into. They're a lot of times a lot more passive, where they're not managing properties. You'll hear the term triple net leases. You'll hear the term TICs or Delaware Statutory Trust. These are some options that individuals can roll that money into, not have to deal with the maintenance, and also defer paying all those taxes.
And then use that monthly income to help pay for their new investment property?
Exactly. So remember, on the primary, when you sell that, you can take the $500,000, put that towards your retirement home, what you're going to move into and live in ultimately. But then take that additional money, put it into some of these investments that create good yield, good monthly pay, and then that's your retirement.
That's a great solution. So Andrew, the next question would be really for you. Okay, a lot of my clients have a lot of equity tied up in these properties. They've owned them for many years, and yet they want to downsize. But the challenge is the market's moving really, really quickly right now, and the other sellers, are not taking contingent offers. Right. So what are some solutions that you're seeing with your clients that's allowing them to, either bring out money or buy the next house without selling the other one first?
Sure. Well, two things. First of all, a lot of people are concerned. They think, well, I'm not going to qualify for another house without first selling this one. And I would just say, look, sit down with me. We don't charge anything up front for doing this kind of analysis. Sometimes people are quite surprised that they actually can afford to qualify for that next home purchase without first having to sell their outgoing property. And that will give them that flexibility in this competitive marketplace to write an offer that's not contingent on the sale of their house.
Okay.
Can you give me one or two examples of strategies that you might use in helping them buy the next house without using a contingent offer?
Sure. Well, first of all, a lot of lenders out there are not very good at properly calculating income. But working with a professional who really knows how to analyze, whether it's tax returns or other forms of income that you may have, to be able to count that income and qualifying can make all the difference. You may walk into the retail branch of some bank, and the loan officer you're talking to there, they just don't know what they're doing, and they may say you don't qualify. Work with a professional who really knows how to analyze income and tax returns, and maybe able to find ways for you to get it done. The other thing is it's a down payment, and sometimes it makes sense to maybe do a cash-out refinance on their property to use that for the down payment in the interim before they go back and sell it.
That's a good point, Andrew. And some of the concerns that a lot of my clients have at this point or this stage of their life is going to be cash flow. What strategies or solutions would you offer for that?
Yeah, well, our analysis is really is comprehensive, and a lot of times people haven't considered maybe keeping that property and renting it out. So first of all, if they keep that property and rent it out, we can count the rental income to help them qualify for the next purchase. And the advantage there too is that entering that retirement stage of life, people are really looking for cash flow, and if they've got a ton of equity and a very low mortgage payment, the rents have really accelerated here in San Diego, as you know, because of our inventory and our shortage of housing.
Right.
And that may create a nice little cash flow for them in this retirement stage to help them as they buy the new property.
It's a very good point. So Andrew, last question for you is, I have a lot of clients that, could pay all cash and they really don't want a loan. Is there any benefit to those people that a loan may offer that they hadn't thought about?
That's a great question, Gary, and I come up against this all the time. People think, well, I'm just going to pay cash. There is this notion of I don't want to have a mortgage. But there are just other things to consider. First of all, the biggest deduction that most people have on their taxes is the mortgage interest deduction. And so all of a sudden they pay cash for a house, and then next year when they file their taxes, they find out they might actually owe money, or they're not getting back nearly as much as they thought. So there's a tax advantage and a tax strategy to consider about having a mortgage. In addition, interest rates are so low right now that take a loan, because cash is king. And at this stage in your life, God forbid you have some sort of a health emergency or something like that, and to have the money left over to help you through those tough times may be key. If you get into a hard situation where you don't have the income, and then all of a sudden you decide, hey, I need to pull that money back out of the house, you may not qualify for the loan anymore because you don't have any income to show. All right, so it doesn't go both directions. And then the final point I would just say is that talk to your CPA about the concept of acquisition indebtedness. Once you pay cash for a house, if you later decide to pull the money out, you actually can't write off all of the interest. And that's because of the IRS's rule on acquisition indebtedness. Don't really have time to get into that today. Call me or your CPA to explain more, but there's definitely reasons to consider taking a loan on that house.
Gentlemen, I want to say thanks again for joining me today and all the expert advice that you've shared with us. I'm just going to wrap this up with one more point or one more concern that comes up with my clients quite often, and that's about the tax basis. A lot of people are hesitant to sell their old home and buy a new one because they bought their home 20 years ago and their tax basis is so low that if they bought a new property today, it might increase 10 or 15 times. And I want to remind you about Prop 60 and Prop 90. And what that does for you is it allows you to, one time, if you're over the age of 55, transfer your tax basis from the property that you're about to sell into the new property. Where, in example, if you bought the previous property for $100,000 and your tax basis is currently $1,000 and you sell your home today for $1 million, instead of having that $10,000 tax basis, you can move that $1,000 tax basis over. The only catch is you have to buy a property of equal or lesser value within the next 2 calendar years. I hope that information was of value to you. Thanks again for watching, and we'll talk to you soon.